Hamilton is still a hot city when it comes to real estate. Did you know that Netflix just increased your monthly membership cost? And is it a good thing to try and shop around when it's time to renew your mortgage? This is the Ken Parkin Real Estate Podcast. Hi, and welcome to the Ken Parkin Real Estate Podcast, where we talk all things business, real estate, and life hacks to get you through your day. Thanks for joining us and enjoy today's podcast. Hi, and welcome back to another episode of the Ken Parkin Real Estate Podcast. It is Thursday, November 29th, and we are on episode 16 of the Ken Parkin Real Estate Podcast. Just so you know, we do have a Facebook page contest running where I'm giving a $50 gift card to you. If you win the contest, how to enter, simply like the Ken Parkin Real Estate Facebook page. Then like the video that's on my Facebook page talking about the contest. It's super easy to find. Comment done in the comment section there, just so that I know you've watched it, you've seen it. You were entered into the contest. If you want a second chance, share it on your Facebook page, and instead of saying done, say done and shared. That way I know you'll get two chances to win this $50 gift card, which I am going to announce the winner on December 1st. Without further ado, let's get into today's podcast. Off the top, Hamilton still has a pretty crazy market. CBC News wrote a report talking about the Hamilton market and how when the general markets have kind of cooled off, 2018, Hamilton and some of the neighborhoods in Hamilton have stayed pretty hot. They go on to write, in a year that the housing market in Hamilton has sort of cooled, along with the rest of the market basically in Canada, both in sales and prices, pockets of the city are still surging with high demand. And this is according to the Canadian Mortgage and Housing Corporation. Houses around the Gage Park area and in St. Clair have outperformed both on price and number of sales compared to the rest of the Hamilton market in 2018. That means there are more buyers than average and less listings. It's the perfect storm. And this is Anthony Passarelli, back to butchering last names again. He had mentioned this at a Thursday morning meeting of the Hamilton-Burlington Market Economic Outlook for 2019 breakfast, which was hosted by CMHC and the Realtors Association of Hamilton and Burlington. He spoke to a room full of realtors, outlining the strengths and weaknesses of the market, while also pinpointing areas in Hamilton where demand is up or it's sagging. After years of intense activity in the market, things slowed down in 2018. And if you've been listening to any of my podcasts, you'll know this across the board. Things have dramatically slowed down. From January to October, there was a 15% drop in sales compared to 2017, which Passarelli attributes to uncertainties in the job market caused by NAFTA negotiations and other mortgage rate issues, things like mortgage rate changes and making it harder for someone to qualify. I don't really think the job market caused by NAFTA negotiations was the issue. I don't think we have the data to really prove that. I'm not saying he's wrong by any stretch of the imagination, but I just don't know what data he used to come to that conclusion. I think it's more, a lot of people have bought and sold. The market has cooled down more because interest rates are going up and it's becoming harder and harder to purchase and to qualify, I should say. The average home price in Hamilton has dropped slightly. It's down 2% after 2017, between 2017 to 2018. But there are still some spots, and this article highlights Hamilton, but there are spots all over the GTA where the market is still moving and outperforming in different parts of the city versus other parts of the city. He goes on to say that 2019 is going to be a better year, along with CMHC. They expect sales to jump between 11 and 18% and for the average price to grow between 4 and 10%. These figures would put the average sale price of a home in Hamilton between $620,000 and $585,000. CMHC also found that the housing starts shot way up this year. 5-year average for housing starts in the region were 2,788. This year, 2018, they were 3,292. So there was significantly more housing starts. They're also predicting condo projects to surge well above average. He says he predicts a scale back between 2,650 to 3,150 housing starts next year. But as evidenced by sheer number of cranes in the sky, 2018 was a banner year for condo projects. The average condo, 5-year average for condo starts is 737. Last year was more than double at 1,803 condo starts. Pretty crazy. And while condos might be booming, vacancy rates for rentals, we talked about that on yesterday's podcast, are below the 10-year average. He said there is not a lot of choice for rentals, and there is definitely a need for new units. Pretty crazy when it comes to the Hamilton real estate market. Are you looking for a new mortgage? Are you up for renewal? Well, if you are up for renewal, this isn't for people that are purchasing. This is for people that own a house. Their 5-year, 4-year, 3-year term is up. What do? Do you stay with your current lender, or do you shop around and look for a new mortgage? On the HuffingtonPost.ca, Daniel Tenser, who I actually enjoy reading a lot of his material, wrote an article that last year marked the beginning of a new era for Canadian households. Economists at CIBC declared in a report issued in September, for the first time since 1990, since the early 90s, interest rates that banks base their fixed mortgage rates on are higher than they were 5 years earlier. In Canada, where 4 out of 5 mortgages are a 5-year fixed rate. Think about that. In Canada, 4 out of 5 mortgages, 4 out of 5 people have a fixed year 5-year rate. Most borrowers are now facing higher mortgage rates at renewal time than they originally had, meaning 5 years ago you could get a fixed rate at, let's say, 2.5% or 3%. Now the fixed rate's at 3.25%, maybe up to 4 or 5%. Unless you're the tail end of a 25-year mortgage, you will likely not remember a time when the mortgage rates became more expensive as times went on. Typically, mortgage rates, as you start to renew over 5 years, they start to come down. It's going to take a little bit of getting used to. That means, for some people, some serious financial pressure. A new survey that carried out mortgage comparisons on ratehub.ca, great website. I do promote that website on my personal real estate website, RateHub. I've used some of their widgets, so I have mortgage calculators, affordability calculators. They have some awesome apps and widgets. 31% of mortgage holders said they could afford no more than a $100 increase. That's actually pretty alarming. 31%. 31% of people out there can handle no more than a $100 increase to their monthly payments. On a mortgage initially worth $400,000, it would only take 0.6 of a percentage point to increase an increase in the rates to actually make that $100 viable. If it was 0.7, it'd be like $107, $108. The thing is, though, the chances are good that your own lender will make things even worse at renewal time. The reason is mortgage lenders tend to give higher rates to borrowers who are renewing than new customers, right? The lender feels like they've got you, you're not going to go anywhere, and you're going to just sign on the dotted line, where when you're a new purchaser, they're trying to entice you with they want to lend you money. They want you to borrow. That's how they make their money. They make their money on the interest payments. A great number of people don't do any comparison shopping whatsoever. And the banks, they know about this. They take advantage of it. They want to get you back, and they know you're not going to shop around. Why would you? All your banking's with, let's say, CIBC. You've got the app on your phone. Your mortgage payments you watch every month as they come out. And why would you change? It's one way lenders maximize profits, because we're lazy as a society. There's no reward for being loyal, and you think there would be. The new federally mandated mortgage stress test complicates things as well. Someone who changes lenders at renewal time, they now have to pass that test. They didn't have to 5 years ago. And that's federally regulated for institutions like banks and credit unions. But if you stick with your current lender, guess what? You don't have to pass that test. There's no stress test. So it makes it, the lenders know that, and so because of that no stress test, it's easier to stay with your current lender even if you're going to pay more per month. The stress test requires you to qualify at a rate that is 2 percentage points higher than the one you're being offered, or the Bank of Canada's posted rate, which is currently at 5.34%. This is as of November 29th. Whatever's higher, you're going to qualify for. You have to qualify at. Now, the fixed rate could be at, let's say, 3%. Well, technically, it's at 3.34% because the posted rate is 5.34%. But, so 2 percentage points higher. The reason why they're doing this is they're saying, we want to make sure if the rates go to 5% at the time of your renewal, you can afford it. The problem with that theory is in 5 years, you might be in a different financial position. So I feel these stress tests are a little bit out to date and not really, they don't make sense because hindsight is 5 years from now, again, you could be in a different position. Many borrowers are now compelled to renew their mortgage rates with their current lender out of fear of having to requalify. As many as 1 in 10 renewals could be rejected of the stress test. And if that happens, your odds of getting a good mortgage rate are practically nil, as no federally regulated bank or credit union can give you a mortgage. You'll have to move to alternative lenders that will most certainly charge higher mortgage rates than the bank. Not only that, they're going to charge you a processing fee up front, typically of 1 to 2%. Like, there's a lot that can go wrong if you don't qualify. A great number of people don't do anything when it comes to comparison shopping of banks. They just tend to stay with their current bank. Most homeowners likely will pass the stress test as their income may have increased since they first got their mortgage. Maybe it hasn't, as they might not have originally purchased right at their limit. 5 years ago, though, the laws were different 5 years ago. You didn't have to have 20% down on $1 million mortgage. The process of qualifying was a lot easier 5 years ago than it is now. So I disagree with this. And this is James Laird, of one of the co-founders of Rate Hub. I disagree with that. I think it's going to be harder for homeowners because of the new tests. What do you do if you can't afford a much larger mortgage payment? Number one, Laird says, start by shopping around for better rates. He suggests starting your shopping 120 days before renewal. Consider hiring a mortgage broker. I would not even say consider. You should go and talk to a mortgage broker. Do not go and talk to your bank. Why? Mortgage brokers deal with all of the big banks. They also deal with credit unions. You can get a better deal and have a lot less stress if you deal with a mortgage broker. I can't be more clear than that. If you were buying a home, or if you are in a home and you need to refi, go and talk to a mortgage broker. And if you don't know one, send me an email, sold@kenparkin.com. I would love to refer you some amazing brokers that are out there. And I know some of you listen to this podcast who are brokers. Send me an email if you want to get on my list. I'd love to network with you. But please, if you're purchasing or if you're refinancing, do not walk into your bank. It is the worst decision, in my opinion, you can do financially, because I think you can get a better rate. And it might be your bank that offers you the best rate. But at least go and shop around. Here are some strategies that can help you cope with rising mortgage rates. Switching lenders can help. Switch from a fixed rate to a variable rate. I am unsure if you should do that right now. I think if you can get into a 5-year solid fixed rate, you're not going to move. I feel you should get into that fixed rate. If you're planning on moving, get into a variable. You can still port your mortgage with a fixed, meaning if you're moving and you're going to increase your mortgage or decrease your mortgage, the possibilities there. The fixed rate, it is a little more challenging. You might have to make some interest payments to get out of your existing mortgage. Find a co-signer for your mortgage. Your parents, if you're a baby, if you're a millennial, potentially have the ability to become a co-signer and make it easier for you to qualify. I just don't know. I feel like if you're coming up to your term end, please talk to a mortgage broker. They will help you through the entire process. And Netflix, to finish off this podcast, is raising your monthlies. Typically, I think I'm on the single. I think I'm on, I don't know what I pay. I don't know which plan I have. The basic plan, though, rises from $8.99 to $9.99. You're going to be paying $10 a month to get into Netflix. Basically, there's a couple of plans. The basic plan, you don't get the 4K and allows you to stream on one device at a time, and that's what I think I have. It's $8.99 is going to go to a $9.99. Netflix standard plan, which was $10.99, is going to $13.99. So that's an increase of $3. That allows you to watch content on two devices at the same time. And the premium plan subscribers, you're going from $13.99 up to $16.99, $17 to watch TV shows and movies on 4 devices at the same time. And you can do that in HD or Ultra HD. Netflix is wanting to use the increase of these plans to basically fund new series and films they want, which I'm all for bringing new content. Listen, I think $13 a month or $14 a month to get some really cool shows is not that expensive. The issue up here in Canada is we don't get all the good stuff, which is down, in my opinion, on the on the American platform. So I have issues with some of the content that Canadians see, and I don't know how it is in other countries outside of the US, but our content in Canada could be probably a little bit better. And quite honestly, I'm not against Canadian content. That's not my issue, but I feel like they should have the American content that's shared on every platform for Netflix, and then introduce Canadian content and maybe German content if you're in Germany, or British content if you're Brit. Wherever you are, I have no problems promoting that local content. But Netflix is trying to take some market share from companies like Hulu or even YouTube streaming now. So if you are on Netflix, expect your plan to rise very, very soon. That's it for today. I try to stay around 50 minutes. I'm at almost 17 minutes. I'm working on getting it down. Remember, the gift card giveaway is $50, and it's going to go to the winner that I'm going to announce December 1st. To enter the contest, simply go to the Ken Parkin Real Estate podcast. Very easy to do. Sorry, the Ken Parkin Real Estate Facebook page. Very easy. Like the page. Go and find the video that is of me talking about the contest. Like that video, and then say done. I know you've watched it. For a second entry, say done and shared, and you will get share it on your Facebook, on your personal Facebook page. You will get a second entry. I'm also doing a business interview series. If you own a business, if you are a small business owner in the local GTA, I would love to come and check your business out. I am all for promoting local businesses in 2019. I want nothing in return. We are simply interviewing amazing businesses and going from there. So if you are a small business, I'd love to sit down and have a chat with you on film so I can promote your business to all of my database. And quite frankly, I have some amazing small business interviews lined up. And so this database of people who watch these businesses, these interviews, is gonna grow significantly. So the visibility for your business is gonna grow significantly. And we can all use more customers and clients in 2019. I think you would agree with that. My time has run its course. Thank you so much for listening to the podcast. I will be back very, very soon. Have a great Thursday.